JPMorgan pointed out 3 core themes for the second half of this year. First, markets will continue to react and adjust to the tensions between the ongoing energy supply shocks, which the negative, and the resilient growth backdrop, the positive. Expect frequent changes in the market. Next, AI upstream will be the key pillar of growth. And lastly, geopolitical fragmentation will persist, which will be a source of uncertainty across the markets. For inflation and interest rates. Inflation is expected to be sticky across almost every market, and for developed markets, central banks' decisions on interest rate movements will be uneven. For example, European Central Bank already hiked once in mid-June. Attention now falls on the Federal Reserve, and they'll very likely hold interest rates steady for the rest of this year. Now on to S&P 500. Because of the US-led AI supercycle, optimism still holds. The index's year-end price target is at 7,800, and for earnings per share, there's an estimate of 29% year-on-year growth. But the path upwards will not be linear. One reason is because companies in the index have been posting very strong earnings. Every strong quarter resets the bar higher. It'll be increasingly more difficult for companies to provide significant surprise to the upside. Another reason is the potentially tighter monetary policy in the US. In first half of this year, global goods sector's activities performed stronger than expected. That also means consumption levels are not as bad as everyone thought to be. JPMorgan maintained that global expansion stands on solid ground this year. At a glance at the 3 big economies, for US, growth is expected to settle back to 1.5% to 1.75% range for second half of this year. Europe, there are various structural challenges, especially linking to energy shocks. That brings strong direct effects on inflation because of energy prices. For China, growth is expected to average at about 4.7% this year. There's a chance of escalation in tariffs from US. The 3 key risks are on the right. A resurgence of conflict between US and Iran affecting energy prices again. Europe's recent sentiment slide, and China's continued reliance on exports for growth. They haven't recovered from their biggest problem, the weak domestic demand. For credit, the global credit markets remained resilient in first half of this year because bond yields are attractive. That encouraged strong institutional demand for corporate bonds, especially the high-quality US investment-grade ones. But credit spreads are already very tight. Investors are receiving relatively little extra compensation for taking the ad on corporate credit risks. The risk-free rate, US Treasury for this case, is already high. High-quality investment-grade bonds typically don't offer much yield. Therefore, the compensation isn't much. Investors will be choosier. For the high-yield ones, the spread is expected to widen. Because of the preference in investment-grade bonds, the spread for high-yield bonds will deviate further from the risk-free rate. Investors will be more cautious and demand higher returns for the additional risk in high-yield bonds. For oil, the outlook is lowered for second half this year because global demand has weakened more than expected. The second point is a bit of a relief. Oil inventories in developed economies are not falling as sharply as expected. There's less pressure for oil prices to rise. Brent crude will likely average at about $86 per barrel in quarter 3 this year and likely end the year at $78. Gold might reach $6,000 per ounce by end of the year. But this really depends on interest rates movements in the US. Even though long-term supports for gold's price, such as geopolitical tensions, still remain, the risk of further Fed rate hikes holds back gold prices. Because gold bullion is non-yielding, meaning they don't provide yield. When interest rates are high, gold tend to struggle to compete with assets that brings interest income. For currency, US economy may remain stronger than other economies, and interest rates in US may stay relatively attractive. And one last point is the one that we covered in S&P. America's lead in AI may pull more capital towards US. These factors will support the demand for dollar. Elsewhere, even though rate hikes tend to boost currencies, but when it's driven by stagflationary concerns or weakness in the currency, the hike is unlikely to be supportive for the currency. Like Japan, Bank of Japan had to increase interest rates to try to bring Japanese yen up. But that didn't really work. JPMorgan is bearish in Canadian dollars, euros, Japanese yen, and Sweden. In simpler terms, US dollars will likely remain strong because US hosts many companies that are at the center of the AI ecosystem. So many investing activities will occur in the US. Buying US assets generally creates more demand for the dollar. On to US jobs. June's jobs creation cooled sharply, adding 57,000 jobs. Household employment dropped quite a fair bit, with 500,000 fewer people reported at work. The drop in June's labor numbers is because of the drop in labor force participation rate, now at 61.5%, the lowest since March 2021. These are the few reasons: an ongoing wave of baby boomer retirements, stricter immigration policies in U.S., and a growing number of prime-age workers abandoning job hunt because of very limited opportunities. Professional and business services contributed most, and healthcare, this time around, added fewer jobs. It's at a slower than normal pace. Last month, leisure and hospitality added quite a fair bit of jobs, but now they lost 61,000 jobs. Many are speculating that World Cup required a sudden need of manpower and also brought sudden drop. Like a one-off outlier, unemployment didn't really move much now at 4.2%. Hourly earnings are that 3.5% year-on-year. The gap between consumer prices, most recently at 4.2%, is widening now. That erodes spending power. Fed Chairman Kevin Walsh called the jobs picture steady and is more focused in bringing inflation rate down. Some comments from Jefferies: jobs growth is plenty strong enough to maintain the steady employment, but overall, the pace is softening. That suggests that rate hikes are unlikely to happen this year. Next, the market previously priced a potential interest rate hike in September, but this time around, it moved to October, with a 69.2% chance of a hike in end of October. On to Germany. Headline inflation dropped to 2.3%. It's the first time that headline inflation dropped for 2 consecutive months in a row since 2 years ago. And interestingly, core inflation is higher than headline figure this time around. Core inflation is the one without food and energy prices. When the headline figure is lower than cores, that means energy and food prices have gone softer. However, the drop in energy prices is because of the government's tax rebate on fuel, and that's coming to an end. So inflation likely will pick up in July, and then the immediate effects will fall on transportation costs, food prices, and industrial products. Also, the heat wave in Europe could damage crops, and that'll often push food prices higher. China's manufacturing expanded faster than expected. The Purchasing Managers' Index is now at 50.3, anything above 50 points to an expansionary zone. China's manufacturing engine has remained resilient this year because of high-tech production climbing on the demand linked to global AI investment boom. That helps China to offset the drag from the Middle East turmoil and also weak domestic demand. And industrial profits are also good for the upstream sectors, which are the raw materials and basic inputs industries, and also AI and renewable energy. The downstream ones, which are manufacturing and consumer goods, still remain under pressure. Some comments on Bank of America. Because of the imbalance between the resilient supply and weak demand, that renewed some concerns of deflation. Remember that China struggles with low inflation, and then the Middle East war happened, which pushed their inflation levels up. But now, as the war may come to an end soon, the energy costs that recently dropped are expected to go lower. China may struggle with deflation again because of the weak domestic demand. And if third quarter's GDP disappoints, the government will likely come in with stimulus support. Let's try to link the topics we covered to the market. Again, this is not a buying guide. This is to show how global trends affect different industries. With the highest gain, China Resources New Energy recently gained 137%. We covered that industrial profits in the upstream sector, which are raw materials and basic inputs industries, and also AI and renewable energy posted strong industrial profits. Next, Marvell Technology. Its shares gained 22.5%. Jensen Huang called this company the next trillion-dollar company. But more importantly, the company reported stronger revenue forecasts because hyperscalers are spending aggressively in AI data centers, custom chips, and interconnect solutions. So, like what JPMorgan pointed out, AI upstream remains the core growth pillar. Then, Aixtron rose 13% after raising guidance on stronger demand for optoelectronics equipment. Lastly, airlines, Lufthansa. Because traffic at Strait of Hormuz is opened, oil prices dropped, and also for Germany's softer energy prices. These help airline companies.